Welcome back, ladies and gentlemen. Today we are talking about bonds. Our guest, Karlheinz Dobnigg, CEO of the AURAC AG. First of all, Mr. Dobbnig, what are bonds?
Yes, thank you for having me. Generally speaking, a bond is a fixed or a variable interest security issued either by companies or states to raise capital. The issuer commits to making regular interest payments to the bondholder and repaying the principal amount at the end of the term.
Can you explain what are rights and obligations of bondholders?
Sure. A bondholder has the right to regular interest payments and the repayment of the bond's face value at maturity. In return, the bondholder is obliged to provide the capital for the duration of the term. Unlike shareholders, bondholders do not have voting rights in the company.
Mr. Dobbnig, what are the main advantages of bonds?
Yes, I think we can say bonds provide investors with a stable and predictable income source through interest payments. They are typically less volatile than stocks, making them safer investment. Additionally, bonds generally have priority over stocks in repayment during insolvency.
Okay, that are the advantages. Are there any risks of bonds?
Yes, I think we can say that the main risks include credit risk, which is the possibility that the issuer may not be able to make interest payments or even repay the principal. And interest rate risk, where rising market interest rates can reduce the bond's value. There is also inflation risk, which can diminish the real return of the bond.
Mr. Dobbnig, what do you think? Who are suitable investors?
I think bonds are ideal for investors seeking a stable and reliable income source. They are also suitable for those looking to diversify their investment portfolio to spread the risk. Due to their lower volatility, they are generally also appropriate for more conservative investors.
Well, my next question would be, how do bonds differ from other investment types like stocks and profit-sharing certificates?
I think we can say bonds offer fixed or variable interest payments and have priority in repayment during insolvency. But they do not provide voting rights in the company. In contrast, stocks do not guarantee dividends, but offering voting rights. Profit-sharing certificates combine elements of stocks and bonds, offer no voting rights, and are usually subordinated in case of insolvency, but provide profit-dependent interest.
What do you think? What should investors consider before investing in bonds?
I think investors should carefully assess the creditworthiness of the issuer to minimize the default risk. They should also understand the bond's terms, including its duration, interest structure, and any call provisions. Additionally, investors should consider the impact of interest rate changes and inflation on their returns and ensuring the bond aligns with their overall investment goals.
Are there different types of bonds?
Yes, there are several types of bonds, including bonds issued by states, corporate bonds, or even municipality bonds, and high-yield bonds. So-called state bonds are issued by states and are considered very safe due to their low default risk. Corporate bonds are issued by companies and typically offer higher yields but come with higher risks. And municipality bonds are issued by cities or local authorities and are also considered very safe, I would say. High yield bonds, as also known as junk bonds, offer high returns but come also, of course, with very high default risks.
Mr. Dobnigg, can you explain how interest rate changes affect the value of bonds?
Well, when market interest rates rise, the value of existing bonds decreases because their fixed interest payments become less attractive. Conversely, the value of existing bonds increases when market interest rates fall. Investors should be aware of this interest rate risk, especially if they plan to sell their bonds before maturity.
Is it right? There are fixed rate and floating rate bonds. What is the difference between both?
Well, yes, there are fixed rate bonds who have set interest rate that remains constantly over the bond's term. Floating rate bonds have interest rates that adjust periodically based on a reference rate such as LIBOR or Euribor, you might know. Floating rate bonds offer protection against rising interest rates, but may be less disadvantageous if rates fall.
What kind of role play bonds in the global economy?
I think we can say bonds play a crucial role in the global economy by enabling states as well as companies to raise capital, to finance projects, develop infrastructure and refinance debt. Bond markets are also indicators of economic wealth and health and interest rate trends in various regions.
As an investor, how can you minimize risks?
I think it's important that diversification is here a key to minimize the risk. Investors should invest in a mix of bonds with different maturities, issuers and credit qualities. It is also important to stay informed about the financial health of issuers and also the economic conditions. Investors might consider bond funds or ETFs for broader diversification.
Mr. Dobnigg, there are so-called green bonds. How do they differ from traditional bonds?
Green bonds are bonds whose proceeds are used exclusively to finance environmentally friendly projects, such as renewable energy, energy efficiency, or sustainable agriculture. They differ from traditional bonds due to their specific focus on environmental benefits. So for social responsible investors, I think green bonds offer a way to achieve returns while supporting positively ecological impacts.
Could you sum up the different perspective of bonds?
I will try. Bonds are securities issued by companies or states to raise capital, offering regular interest payments and principal repayment to the bondholders. Bonds provide a stable and predictable income source, are less volatile than stocks, for example, and having priority in repayment during insolvency, but come with risks like credit risks and interest rate risk. We can also say that it is important to assess issuers' creditworthiness, the impact of interest rate changes, and the benefits of diversification in minimizing investment risks.
Mr. Dobnigg, thank you for your time.
My pleasure. I'm glad to provide this information.
Thank you. And thank you for watching.